Good afternoon, everybody. So, in the last class, we had a discussion about the financial statement analysis, and in that connection, we discussed about the horizontal analysis and vertical analysis. Under horizontal analysis, which is otherwise known as the dynamic analysis, we discussed about the comparative statement analysis and trend analysis. There are two other tools which are coming under this horizontal analysis. They are funds flow statement and cash flow statement. They were not intentionally discussed yesterday because of their lengthy in nature, which is to be discussed today. So funds flow statement, which is a part of the horizontal analysis coming under the financial statement analysis. So let us first discuss about the term fund. The term fund doesn't necessarily mean that the cash and bank balance only. Of course, if we ask somebody instantly that what is the fund position of yours, so whatever amount is available in its purse or its pockets or in hand, that would be regarded as its fund in the instant position. So in that case, the cash balance is necessarily meant to be the fund of that particular person on that particular event. But if he has given a loan, he has parted with a loan to somebody on short-term basis, his cash balance will definitely reduce to the extent of the loan he has given to his friend or to his neighbor or to anybody else, which is to be collected from that particular person, from the borrower, whenever he desires to collect it. That is given on short-term basis. Suppose the moment he was asked for to count his cash and bank cash balance in his pocket or in his purse, it comes to 5,000 rupees, out of which 500 rupees was given to a friend as a loan on short-term basis. So in the first instance, the cash balance was 5,000 rupees and his fund was 5,000 rupees. In the second instance, when 500 rupees loan is given to a third party, the cash balance is reduced from 5,000 to 4,500, but his fund position will remain same to be 5,000, because that 500 which is parted with its friend is a current asset which is to be returned or which is to be recovered at any point of time whenever he desires to do so. So fund doesn't necessarily mean the cash balance. Cash balance, although the cash in the second instance, the cash balance is reduced to 4,500, the fund position of that particular person remains same to be 5,000. So what it found in its actuality? The meaning of the term fund exactly is it is the net current asset, which is otherwise called the free current asset, or the excess of current assets over current liability, or the current assets minus current liabilities, or in other words, we can say it to be the net working capital. So the exact terminology used for fund is net working capital. That means the equation of net working capital is current assets minus current liability, which is otherwise called the free current assets or net current asset or excess of current assets over current liability. So that is what the meaning of the term fund is. Then what is flow of fund? The flow of fund means the changes in the fund position. The change may be a positive flow, the change may be a negative flow. Suppose the current asset minus current liability, which is the equation of the term fund, is 10,000 rupees for a particular person at a particular instance. And when the next transaction takes place, it increases the fund from 10,000 to say 10,200. So that type of flow of fund is called the positive flow of fund because it increases the fund position. So when the fund position increases due to any transaction, that is called flow of fund, and that flow of fund would be regarded as the sources of fund or positive flow of fund. On the eventuality of reduction in the fund position, that is called the negative flow of fund, or it is otherwise called the usage of funds or the application of funds. So the flow of funds are of two types, either negative flow or positive flow. Positive flow is known as sources of funds and negative flow is known as uses of funds or application of funds. So that is about flow of fund. So how that flow of fund takes place? That flow of fund takes place. I'm giving an example. Suppose the current asset of a particular organization is say 1 lakh rupees and the current liability is 50,000. So the fund would be 1 lakhs minus 50,000, that would be 50,000 rupees. That would be the fund, or that would be the net working capital. At this juncture, suppose 5,000 rupees is recovered from a debtor in form of cash. Will it make a flow of fund, or will it cause any change in the fund's position? Will it increase the current asset or current liability of the organization? This particular transaction is collection of 5,000 rupees from the debtors. If we'll analyze the transaction through a journal, the entry for this would be when the amount is realized from the debtors, 5,000 rupees cash is realized from the debtors, the entry would be cash account debited to sundry debtors account. Cash is a current asset, sundry debtor is a current asset. So both are belonging to the one and the same category, that is current asset. One current asset increases, that means cash. When the cash comes in, the balance of cash or the volume of cash increases. And the another current asset, that is sundry debtor, it is reduced, because when the amount is collected from the sundry debtors, the volume of sundry debtor will go down. So when this transaction takes place, in totality, the current asset of the organization will remain same, because one current asset, that is cash, will go up by 5,000 and the other current asset, that is debtors, will go down by 5,000. So the total current asset will remain same, and this transaction doesn't affect the current liability in any manner. So the equation of fund will also remain same, because this transaction doesn't result into any flow of funds. Neither the fund will be increased nor the fund will be decreased by this transaction. Both the transactions belonging to the current category and the two current assets only. I am giving another example. Suppose the amount paid to sundry creditors, 3,000 rupees. When amount of 3,000 is paid to the sundry creditors, the entry would be what? The creditors account will be debited and the cash account will be credited, because the cash goes out and the creditors is being paid. So when this transaction takes place, this will also not resulted into any flow of funds, because the fund position will remain intact, same with 1 lakh, it will neither increase nor decrease. How? When current liability, that means sundry creditor is represented through current liability is reduced by 3,000 rupees, and the other hand, current asset is also reduced by 3,000 rupees on account of cash, because cash is paid to the creditors. So the equation of fund will remain same, because 3,000 is reduced from the current liability and 3,000 reduced from the current assets. So the fund position will remain same, which is the net working capital or the fund, or the difference between the current assets minus current liability. So the second transaction also, it doesn't result into flow of fund, because the fund position remain intact as usual without affecting any change or any increase or any decrease. Let's take the example of a third transaction and we'll see that what happens due to this. Suppose a computer is purchased on payment of 50,000 rupees. When a computer is purchased on payment of 50,000 rupees, the entry will be computer account debited to cash account. Cash is being paid on account of purchase of furniture. So what will happen? Furniture is not a current asset, but cash is a current asset. So when cash is paid, cash is being reduced by 50,000, and it will definitely reduce the net current asset position or the fund position by 50,000 rupees. So this resulted into an application of funds or negative flow of funds, which is otherwise called the usage of funds. So now let us analyze all the three transactions. Why in the first two transactions there was no flow of fund, and in the third transactions resulted into a negative flow of fund of rupees 50,000 rupees. In the first two transactions, both the aspects of the entry or both the aspects of a transaction are belonging to the same category, that is current assets only. Current asset, one current asset increases and the other current asset decreases. In the second transaction, one belonging to the current liability, that is hundred creditor, and the second one is belonging to the current asset, that is cash. The current liability is reduced, current asset is reduced. So the volume of fund remains same, because the current asset, when the current liability is reduced and current asset is reduced, the resultant would not affect the fund position, it will remain same. But in the third transaction, out of both the aspects, one belongs to a non-current category, that is fixed asset. For purpose of, kindly remember that for purpose of cash flow or funds flow, the assets and liabilities are segregated into two categories only: current asset, or if it is not a current asset, all other assets would be categorized as a non-current asset. Similarly, for liabilities, current liability, and if it is not a current liability, all other liabilities are to be regarded as non-current liability. What is a current asset? Current assets are having three characteristics. Current assets are those short-term assets which are to be converted into cash or cash equivalent, or which is to be used in the process of production, or which is to be consumed within one accounting cycle or within one financial year. So whenever any asset is fulfilling any of the three criteria, that means first one is to be, is it convertibility into cash, to be consumed, or to be used in the process of production within one accounting cycle or one financial year. So that is called current asset. And any asset which is not a current asset, for purpose of funds flow and cash flow, they are to be treated as a non-current asset only. No fixed asset, no fictitious asset, no movable asset, no immovable asset, nothing of that sort, current or non-current. Similar is the case of liabilities. The liabilities are to be segregated as current liability, and if it is not a current liability, then all other liabilities are to be treated as a non-current liability. So that has to be thoroughly remembered in case of funds flow and cash flow statement. So in the third transaction, when a computer was purchased on payment of 50,000 rupees of cash, fixed asset, that means the computer account will be debited by 50,000 with a corresponding credit to the cash or bank balance. Cash or bank balance is obviously a current asset, but computer is not a current asset, it is a non-current asset. So out of both the aspects of the third transaction, one belonging to a non-current category, whereas the other belonging to the current category. So it is to be remembered that when out of both the aspects of a transaction, one aspect is belonging to the current category and the other aspect is belonging to the non-current category, that will result into flow of funds, either positive or negative. And when both the aspects of a transaction are belonging to the same category, either current or non-current, then it will not result into flow of funds. That is the essence of this discussion. Suppose we have issued share capital for buying of a car. The car, worth of the car is 6 lakhs rupees, and the company has issued share capital worth rupees 6 lakhs rupees for buying of a car. So the entry for this would be car account debited to share capital account. Car is a non-current asset, being a fixed asset, and share capital is also a non-current liability. So both belonging to non-current category. When both belonging to the current category or when both belonging to the non-current category, it will not affect the fund position. It will not result into flow of fund. But when one aspect belongs to current category and the other aspect belongs to non-current category, then only there would be flow of funds, either positive or negative. That has to be thoroughly remembered in case of this. So this is about flow of fund. flow of fund, how the flow of fund is resulted into, and the flow of fund can be of two types, either positive flow of funds which is known as sources of funds, or negative flow of funds which is known as the uses of funds or application of funds. So after fund and flow of fund, let us discuss about the fund flow statement. What is funds flow statement? Funds flow statement, as we have seen, that it is an additional statement. It is just not like the profit and loss account or the profitability statement or the balance sheet or the statement of financial position. We used to prepare the profit and loss account or the profit and loss statement or the income statement in order to determine the operating result of the organization, whether net profit or net loss, whether the organization has earned net profit or it has sustained net loss. That can be ascertained by preparing the profit and loss account. And the balance sheet is prepared to know the financial position or the position of assets and liabilities on a particular date. That means when it is prepared on yearly basis, it is prepared on the closing day of the year. So the balance sheet speaks about the position of assets and liability, and the income statement speaks about the profitability of the organization. Then what is the utility of preparation of the funds flow statement? The balance sheet cannot say that where from we got the resources or what are the sources of our funds and in what way that fund gets utilized during that particular period. That can be ascertained by preparing the funds flow statement. That's why the funds flow statement is otherwise called the where come, where gone statement. The different sources from which the funds are coming into the organization or the different sources from which the funds have been generated by the organization during a particular period, and in what way that fund gets utilized on different aspects during that particular period. That can be ascertained by preparing the funds flow statement. Remember that the first balance sheet of the organization, is just like or just equivalent to the funds flow statement of that particular organization for the first year. The first balance sheet would be exactly similar or equivalent to that of the funds flow statement. But from the next year onwards, it will not remain same. So this is about the funds flow statement. So how the funds flow statement is to be prepared? In order to prepare the funds flow statement, there are 4 steps involved in this. The steps are, the first step is statement of changes in working capital. The statement of changes in working capital. That is the very first step involved in preparation of the funds flow statement. The very second step in preparation of the funds flow statement is preparation of individual accounts involving hidden transactions. Individual accounts need to be prepared wherein the transactions are supposed to be in a hidden manner. The third one is preparation of the memorandum profit and loss account or the adjusted profit and loss account. That's the third step of the preparation of funds flow statement. And the last step is the funds flow statement, which is called the final step or the fourth step, wherein we will prepare the sources or application of funds. So the first stage is to prepare the statement of changes in working capital. Then what is the raw material for preparation, or what is the data, or what is the input required for preparation of the funds flow statement? The consecutive balance sheet, 2 consecutive balance sheets. That means the figures of 2 successive balance sheets are required as the raw material or as the data basing on which the funds flow statement are to be prepared. So here, if we look to the example given here, the following balance sheet of X Limited, you are required to prepare the schedule of changes in working capital and the statement of flow of funds or the funds flow statement, you can say. The data is of the raw material or the input required for preparation of the funds flow statement is the 2 consecutive balance sheets of the 2 successive balance sheets without any gap. Here it is given the balance sheet for the year 31st December 2005, and the next balance sheet is 31st December 2006. The liabilities have been given, the assets have been given in form of the balance sheet. This is the data basing on which we would require to prepare the funds flow statement. And the very first step in preparation of the funds flow statement is the schedule of changes in working capital or the statement of changes in working capital. Let us see how the statement of changes in working capital is being prepared out of this. It is having different columns. The first column is for particulars, where the name of the assets or the particulars of assets and liabilities have to be written. The liabilities are capital, balance in the profit and loss account, creditors, mortgage, or you can take it to be the long-term loan. The next column is the figure as on 31st March 2005 and the figure as on 31st March 2006. Exactly the figures given in the balance sheet has been reproduced here. The capital as on 31st March 2005 was 80,000, and the same figure in the subsequent year, that means on 31st March 2006, was 85,000. And the profit and loss account, or the profit and loss appropriation account, or the debit balance of the profit and loss account, or you can say it to be the cumulative profit and loss account. As on 31st March 2005, it was 14,500, and as on 31st March 2006, it is 24,500. And creditors was 9,000 on 31st March 2005, and as on 31st March 2006, it was 5,000. And the mortgage or the loan was nil as on 31st March 2005, and it has become 5,000 in the year 31st March 2006. This is about the assets, this is about the liabilities of the balance sheet. Similarly, the assets figures have been given. Land and building 50,000 as on 31st March 2005, and it remains same as on 31st March 2006, that is 50,000. Plant and machinery was 24,000 as on 31st March 2005 and 34,000 as on 31st March 2006. Stock, it was 9,000 as on 31st March 2005 and 7,000 as on 31st March 2006. Debentures, it was 16,500 as on 31st March 2005 and 19,500 as on 31st March 2006. And the cash and bank balance was 4,000 as on 31st March 2005 and 9,000 as on 31st March 2006. The total of liabilities as on 31st March 2005 was 1,03,500, and the total of assets was also 1,03,500. Similarly, as on 31st March 2006, the total of liabilities was 1,19,500, whereas as on 31st March 2006, the total of assets also remaining the same figure. So in the same figure, that is 1,19,500. So that is the data given to us for preparation of the funds flow statement. And the very first step in the funds flow statement is to prepare the statement of changes in working capital. In the first three columns of the statement of changes in working capital, the figures given in the question or the figures given in form of the balance sheet have been reproduced and nothing else. The capital as on 31st March 2005 was 80,000, and as on 31st March 2006 was 85,000 as stated in the balance sheet. So it is just reproduced there. Similarly, the profit and loss account is also reproduced as 14,500 and 24,500, which is nothing but the accumulated profit or the cumulative profit as on the two balance sheet dates. Creditors was 9,000 and it was 9,000 on 2005, and it was 5,000 as on 2006, 31st March 2006. Mortgage or the loan, it was 0 as on 31st March 2005 and 5,000 as on 31st March 2006. So the next column was changes in current items. changes in current items are of two columns, consists of two columns. One is the debit column, another is the credit column. Similarly, the last column in the statement of changes in working capital is changes in the non-current items, non-current assets and liabilities. It is also having two columns, one is debit, another is credit. Now let us see how the figures are to be inserted in these last two columns, changes in current items and changes in non-current items. As we have discussed that for purpose of funds flow or cash flow statement, the assets are of two categories, either current assets or non-current asset, and either current liability or non-current liability. So whenever there is any change in current items, either current liability or current asset, it has to be accordingly put under the changes in current category. And when the changes takes place in respect of non-current items, it will go to the last column, that is changes in non-current category, last two columns. So let us examine the first item in the liability side of the balance sheet, that is capital. Capital was 80,000 at the beginning and 85,000 at the end, means increased by 5,000. So what is the nature of capital? It's liability, current or non-current? Obviously it is non-current. So when it is non-current, the increase in capital by 5,000, it will affect the last column, that is changes in non-current items, and it will not affect the changes in current items category. So changes in current items are become marked nil. So capital is liability, and liability always shows credit balance. When credit balance increases, it was 80,000 at the beginning and 85,000 at the end, means it has increased by 5,000. So when a liability increases, liability shows credit balance. When a credit balance increases, it can be increased only by crediting this. So it has to be inserted out of, there are two columns in the changes in non-current item, one is debit, another is credit. So it will definitely go to the credit column because it is a change in the liability and that to increase. So when a liability increases, it must have been credited. So it will come under the credit column of the non-current category. Second item is profit and loss account. Profit and loss account, or the accumulated profit or the cumulative balance in the profit and loss account, is also a non-current liability. It was 14,500 at the beginning and 24,500 at the end. That means it has increased by 10,000 rupees. So since it is a non-current item, it will not affect the changes in current item category. So both the debit and credit have been shown nil. And since the liability is increased, it must have been credited. So this item also appears in the credit column of the non-current category, that is 10,000. Then creditors. Creditors was 9,000 at the beginning, 5,000 at the end, means it is decreased by 4,000 rupees. And creditor belongs to which type of or which category of liability? It is obviously a current liability because it is a short-term liability. So liability was 9,000 at the beginning and 5,000 at the end, means it has decreased by 4,000 rupees. When a liability decreases, liability increase means it has to be credited because liability shows credit balance. But when liability decreases, it must have been debited. So here it must appear that 4,000 decrease in current liability must appear under the current category, changes in the current category, and that too in the debit column, because when liability shows credit balance, and when liability is reduced, it must have been debited. So it comes in the debit column of the current category. Last one is the mortgage or loan. It was 0 at the beginning of the year, that means as on 31st March 2005, and it became 5,000 at the end of the year, second year, that is 31st March 2006, resulting into an increase 5,000 in the loan. So loan, it is a mortgage loan, means it must be long-term in nature, so it must be non-current in nature. So when the liability increases, it must have been credited, and since it is long-term in nature, it has gone to the last column, that is changes in non-current categories, and 5,000 is mentioned in the last column or the credit column of the non-current category. So the treatment is offered to all the liabilities of the balance sheet provided to us for preparation of the statement of changes in working capital. Normally, in most of the books, you will see that the last two columns are not there. That means changes in non-current items are not given, because the changes in working capital is only confined to changes in current items, that means current assets and current liabilities. But in our own interest, we must go for preparation of these two additional columns for changes in non-current items or non-current categories, because it will help us in two ways. First, by preparation of these, by addition of these two additional columns, that means that means changes in a non-current category. First, it will help us to ensure the correctness of the preparation of the changes in working capital. And the second advantage of this is it also facilitates the preparation of the funds flow statement, because the items appearing in the credit column of the non-current category, I am reiterating, the items appearing in the credit column of the non-current category are all sources, and the items appearing in the debit column of the non-current category are all applications. So when we will prepare the funds flow statement in a subsequent stage, we can directly take the figures appearing in the credit column of the non-current category as sources of funds, and we can take the items appearing in the debit column of the non-current category as the application or usage of funds, and obviously the funds flow statement will be telling and it will go over. So in our own interest, we must go for preparation of these two additional columns for non-current category. So we have already seen the treatment offered to different items of liabilities in the statement of changes in working capital. Now let us come to the assets, different assets given in the balance sheet, and what would be its effect or changes in the statement of changes in working capital. So first is land and building. Land and building is an asset, whether current or non-current. Obviously it is non-current. Land and building is a non-current asset. It was 50,000 at the beginning, 50,000 at the end. That means as on 31st March 2005 it was 50,000. As on 31st March 2006 it is also 50,000. So there is no change in it. So all the four columns, changes in current category as well as changes in non-current category, both having debit and credit, would be nil. Then plant and machinery. It was 24,000 as on 31st March 2005 and 34,000 as on 31st March 2006. So plant is also a non-current asset. It's not a current asset, it's a non-current asset. So when non-current asset increases, it was 24,000 at the beginning and 34,000 at the end, means it is increased by 10,000 rupees. So obviously it will go to the non-current category. And non-current category, whether to be debited or to be credited. Plant or an asset always shows a debit balance. When a debit balance increases, it has to be further debited. When a debit balance decreases, it has to be credited. So here there is an increase in the plant and machinery account by 10,000 rupees in comparison to the second year in respect of the first year. So that will appear in the debit column of the non-current category, 10,000 rupees. This is plant. Then stock. Stock was 9,000 at the beginning and 7,000 at the end. But what it is character? Stock is a current or non-current item? Current asset or non-current asset? Stock is a current asset. Stock is a current asset because it fulfills the conditions of becoming a current asset. That means it is a short-term asset which is to be converted into cash or cash equivalent. So stock have to be converted into cash or cash equivalent within one financial year or within one accounting cycle. So obviously it is coming under the category of current asset. Current asset was 9,000. Stock was 9,000 at the beginning and 7,000 at the end, means it is decreased by 2,000 rupees. So when it is coming under the category of current assets, then its changes will obviously be there in the first category. That means changes in current items. So whether it is to be debited or credited, when the asset decreases, asset shows which balance? Asset always shows debit balance. So when the asset decreases, it must have been credited. So obviously these 2,000 rupees will appear in the credit column of the current category. Then the next item is debtors. Debtors is also a current asset. It was 16,500 at the beginning and 19,500 at the end. That means it has been increased by 3,000 rupees. Debtors shows debit balance being an asset. When an asset increases, it must have been debited, further debited. So these 3,000 increase in the sundry debtors from 16,500 to 19,500 will come under the changes in the current item or changes in the current category, that too in the debit column, because asset is increased here. The last item in the asset side of the balance sheet is cash and bank balance. It was 4,000 at the beginning and 9,000 at the 4,000 at the beginning and 9,000 at the end. That means it has gone up by 5,000 or it is increased by 5,000. So when an asset increases, the treatment is just similar to that of the debtors. When the debtor was increased by 3,000, it was debited in the current category. Since cash and bank balance is a current asset, its increase by 5,000 rupees has to be inserted in the debit column of the current category, and it will not affect the non-current category or changes in the non-current items at all. So now we have offered treatment to all the individual items of assets and liabilities given in the balance sheet through preparation of the statement of changes in working capital. So what is the very next step in preparation of the statement of changes in working capital? We need to make the totaling of all the last 4 columns. The last column totaling is coming 5,000 plus 10,000 plus 5,000, that is 20,000. That is credit of non-current category. Then debit column of non-current category, when it is total, it would be 10,000 land and building. And the credit column of the current category, it is coming 2,000 rupees. And the debit column of the current category is coming 12,000 rupees. 4,000, 3,000 plus 5,000. It is coming 12,000 rupees. Then we need to make the balancing of the first 2 columns. That means first two columns of the current category, then next 2 columns of the non-current category. When you make the balancing figure is appearing as a 10,000 and it is coming in the credit column of the current category. When it is coming under the credit column of the current category, then the same figure, when we make the balancing of the last 2 columns, that means changes in the non-current category, the same figure must appear but in the opposite column. The same 10,000 is coming, but it is coming in the debit column of the non-current category. In the current category, it is coming in the credit column. In the non-current category, it is coming on the debit column. When the same figure is coming as the balancing figure in the current category as well as in the non-current category, but in different columns. That means if it comes in the debit column of the current category, it must come in the credit column of the non-current category. If it comes in the credit column of the current category, then it must come in the debit column of the non-current category. When the same figure is coming for current as well as non-current category balancing figure, but in the opposite column, then you can ensure the correctness of the statement of changes in working capital. Here the same 10,000 figure is coming as the balancing figure in the current category in the credit column, and the same 10,000 is coming as the balancing figure in the non-current category, but it is coming in the debit column. So thereby you can ensure that the statement of changes in working capital or the preparation of statement of changes in working capital is fairly all right. So this is the first advantage of having the last or the 2 additional columns, that means columns meant for changes in non-current items or changes in non-current category, changes in non-current assets or non-current liabilities. So the statement, after preparation of the statement of changes in working capital, what the balancing figure is? This balancing figure of 10,000, which is appearing in the credit column of the current category as well as in the debit column of the non-current category, what it is? It is net increase in working capital. When the balancing, please remember that when the balancing figure is coming in the credit column of current category, it will obviously coming in the debit column of the non-current category, and that would be titled as net increase in working capital. And here it is, the balancing figure is the net increase in working capital. It may so happens that at times when the statement of changes in working capital is being prepared, the balancing figure may appear in the debit column of the current category and the credit column in the non-current category. In that case, the balancing figure would be treated or would be titled as, or the nomenclature of the balancing figure would be the net decrease in working capital. Net increase in working capital, net increase in working capital is an application, and the net decrease in working capital is a source. So this is about the first advantage of preparation of the two additional columns, that is for non-current category. The second advantage of having or putting these two additional columns for non-current category in the statement of changes in working capital is it facilitates the preparation of statement of changes in working capital. How does it facilitate? All the items appearing in the credit column of the non-current category would be treated as sources, and all the items appearing in the debit column of the non-current category would be applications in the funds flow statement, and accordingly the funds flow statement will prepare and the funds flow statement will be agreeing. Let us see the preparation of funds flow statement. Here in the funds flow statement, it may be prepared in T shape. The left hand side is for sources and the right hand side is for applications, or it may be prepared in a statement form. First sources, the different items of sources are mentioned, then total of sources, then next application of funds or uses of funds, different items of application of funds or uses of funds, then total. Both the totals must be same in after taking into consideration the net increase or decrease in working capital, which is the resultant of the statement of changes in working capital. Here the first item appearing in the credit column of the non-current category is 5,000 rupees, and it is coming from capital. It is coming from capital means the capital is increased by 5,000 rupees. That means there is an increase of capital by 5,000 rupees in comparison to that of the previous year. So that item is taken as issue of share capital 5,000 rupees. Then the next item is profit and loss account 10,000 rupees. That means the accumulated profit and loss account at the beginning of the year was 14,500, and at the end of the year it is 24,500. That means increase. So why there is an increase in accumulated profit? It must be due to the profit earned during the year. There is no other way. That increase in the profit and loss account must be due to the profit earned during that particular year, that means 2006. So that can be titled as funds from operation. That means the amount of earning or the profit made during the year. So that is also a source. So that is being taken here, 10,000 rupees. Then the next item appearing in the credit column of the non-current items category is 5,000 rupees. That is on account of loan. The loan was 0 at the beginning of the year, and the loan is 5,000 at the end of the year. That means the loan is taken amounting to rupees 5,000 rupees. So that loan is also receipt of a long-term loan. That is also a source. So that is also taken under the sources category. So accordingly, 10,000, 5,000 and 5,000 in total sources of funds became 20,000 rupees. Let us come to the application part. I have said that the items appearing in the debit column of the non-current category would be all application of funds. The first item appearing in the debit column of the non-current category, that is 10,000 rupees, it is on account of plant. Plant was 24,000 at the beginning and 34,000 at the end, means obviously there is addition to plant and machinery or purchase of plant and machinery amounting to rupees 10,000, which is resulting into application of funds. So purchase of plant under application or uses of funds, purchase of plant is taken as 10,000 rupees. And the net increase in working capital is also an application. So taking that into consideration, 10,000 plus 10,000, that would be exactly similar to that of the total sources of funds. So here the sources of funds was 20,000 rupees and the application of funds including the net increase in working capital is 10,000 rupees. So the total of application of fund is also coming 20,000. So this is about funds flow statement. Now the question, there may be a spontaneous question. What about the step 2 and step 3 as given in the earlier enumeration? We have said that there are 4 steps involved in it. But we have simply jumped from the step 1 to the step 4. We have prepared the statement of changes in working capital, then we have directly gone to the step 4, that is preparation of funds flow statement. Then at this juncture, then what is the utility of the step 2 and step 3 in the while preparing the funds flow statement by any organization? The utility of the step 2 and step 3 will come into picture when there is additional information given to the balance sheet. Here simply the figures of the balance sheet has been given, and taking that into consideration, we have prepared the funds flow statement without thinking that there is any hidden transaction, or without considering that there is any additional information given to the balance sheet. Had there been any additional information given to the balance sheet, then there would have been the utility of the step 2 and the step 3. Step 2 is for preparation of individual accounts involving hidden transaction. Suppose here the plant and machinery, land and building, suppose it is not subject to depreciation, so the figure remains same 50,000, it is acceptable. But when the plant and machineries are there, it was 24,000 at the beginning and 34,000 at the end. The addition, we have simply taken it as the increase in the plant position, purchase of plant position. So accordingly, we have taken it as application under the head purchase of land. But had there been any depreciation to the plant and machinery, the plants are subject to depreciation or not? Depreciation means the gradual decrease in the value of fixed assets due to wear and tear. So when the plants are put to use in the organization, then it is obviously subject to depreciation or not. So if the additional information is given that the plant is subject to depreciation at the rate of 10% during the year 2006, that means 2,400 rupees depreciation has been written off from plant and machinery. So if that piece of information is provided to us, we need to prepare the individual account of the plant and machinery. The opening balance has to be taken as 24,000. The closing balance has to be taken as 34,000. And that 2,400 of depreciation must have been credited to the plant and machinery, because when the depreciation is written off on plant and machinery, the entry would be depreciation on plant and machinery account debited to plant and machinery account. So obviously that 2,400 amount will appear in the credit side of the plant and machinery account. After that, when you make the balancing of the plant and machinery account, the credit side would be 34,000 plus 2,400, that means 36,400, and the debit side would be 24,000. And when we make the balancing figure would be not 10,000 as computed earlier, it would be 12,400, and that 12,400 debited to plant and machinery means it obviously signifies that the addition to plant and machinery is 12,400, not 10,000 as calculated earlier. So the actual purchase of plant and machinery has to be considered as 12,400, not 2,000, not 10,000 as calculated earlier. So the application of funds would be 10,400 on account of purchase of plant and machinery, and net increase in working capital would be 10,000. So the total application of funds would be 22,400. So what would be the changes in the sources of funds? This here, the utility of step 3 is coming into picture. We need to prepare the the statement of changes, the memorandum profit and loss account, or the adjusted profit and loss account for this purpose. If we look to the profit and loss account given in the example, given in the illustration, it was 14,500 at the beginning and 24,500 at the end, means the profit made during the year was 10,000 rupees, and accordingly we have taken the funds from operation as 10,000 rupees. So how this is arrived at? This is arrived at because all expenses, whatever expenses are incurred in the organization, whether it is paid or payable, it resulted into application of funds, and all incomes, it resulted into sources of funds. Instead of taking all incomes as sources of funds and all expenses as application of funds, we are taking the balancing of the expenses and incomes, That means if it is net profit, then we are taking it as the sources of funds, and if there is net loss, we are taking it as the application of funds. But there are certain items of expenses and incomes which do not resulted into flow of funds, but they are taken into the profit and loss account. Take the example of depreciation. All expenses resulted into application of funds, but depreciation being an expense, it is debited to the profit and loss account, but it doesn't resulted into application of funds. How? The entry for depreciation would be, the first entry for depreciation would be the depreciation on plant and machinery account debited to plant and machinery account. That is the first entry. The amount would be 2,400. Then the depreciation ought to be transferred to the profit and loss account. The entry would be profit and loss account debited to depreciation on plant and machinery account 2,400. So here there are two sets of entries. The first entry is depreciation account debited to plant and machinery. Then profit and loss account debited to depreciation. So depreciation is debited by 2,400 and depreciation is credited by 2,400. Both the accounts can be nullified, and the resultant entry remaining is profit and loss account debited to plant and machinery account 2,400. Plant and machinery credited, reduced by 2,400, and profit and loss account is debited by 2,400. Profit and loss account is what type of account? Liability or asset? Obviously a liability. Current or non-current? Obviously non-current. So it is belonging to the non-current liability category. First. Second aspect is the plant and machinery. What category it is? It is asset. What type of asset? It is non-current asset. So both the aspects of the transaction belonging to the same category, that is non-current. One is non-current liability, another is non-current asset. When both the aspects are belonging to the same category, either current or non-current, it will not result into flow of funds. So depreciation will not result into flow of funds. But depreciation being an expense, it should have been resulted into application of funds. So when items like depreciation is there in the profit and loss account, then the net profit cannot be taken as the funds from operation. It has to undergo a change. The amount of expenses debited to the profit and loss account not resulting into application of fund has to be added to the net profit in order to arrive at the net funds from operation. So in order to do that, there is utility for preparation of the memorandum profit and loss account or adjusted profit and loss account. The opening balance has to be taken in the credit side of the adjusted profit and loss account. The closing balance has to be taken in the debit side of the adjusted profit and loss account. And the items like depreciation written off is to be taken in the debit side of the memorandum P&L account or adjusted profit and loss account. And thereafter, the balancing of the memorandum profit and loss account or the adjusted profit and loss account has to be done. Here, 34,000 will be taken, 14,500 has to be taken as the opening balance in the credit column of the adjusted profit and loss account, and 24,500 has to be taken in the debit side of the adjusted profit and loss account, and 2,400 has to be shown in the debit side of the memorandum PL accounts. When the balancing of the adjusted profit and loss account done, the resultant would be the 12,400. That 12,400 will be appearing in the credit column of the memorandum profit and loss account. When the credit column, when the memorandum profit and loss account is showing a balancing figure in its credit column, that would be the funds from operation. So here the actual funds from operation comes to 12,400, not 10,400 as determined earlier. So in the source, under the sources of funds, when we took the funds from operation as 10,000 earlier, it would be 12,400 now. So the total of sources of funds would be 22,400 and total of application of funds would be 22,400. So the funds flow statement agrees. So the utility of step 2 and step 3, that means the preparation of individual accounts involving hidden transaction and the preparation of the memorandum profit and loss account or the adjusted profit and loss account will come into picture when the additional informations are given to the balance sheet. So what are the other items affecting, just like depreciation, what are the other items affecting the funds from operation or the operating profit? These items are to be taken while the care must be taken while preparing the statement, memorandum profit and loss account, the adjusted profit and loss account. The debit balance must be appearing, the opening balance must be appearing in the credit side of the memorandum PL account. The closing balance must be appearing in the debit side, and the items like depreciation written off, loss on sale of fixed assets, increase in reserve, decrease in goodwill, provision for income tax, proposed dividend or interim dividend, all the items are to be taken in the debit side of the memorandum PL account. Similarly, what are the items to be taken into the credit side of the memorandum PL account? The items like gain on sale of fixed assets, decrease in reserve, they are to be taken in the credit side of the profit and loss memorandum PL accounts. Thereafter, the balancing of the memorandum profit and loss account or the adjusted profit and loss account has to be done. If the balancing figure in the memorandum PL account or the adjusted profit and loss account is coming in the debit side of the memorandum PL account, then it is funds lost in operation, FLO. If it is appearing in the credit side or the credit column of the memorandum PL account or the adjusted profit and loss account, it would be funds from operation. Funds from operation if the balancing figure is appearing in the credit side, funds lost in operation if the balancing figure is appearing in the debit side. If it is funds lost in operation, then it will go to the application side of the funds flow statement. If the balancing figure is funds from operation, then it will be appearing in the sources in the funds flow statement, and accordingly the funds flow statement will agree. So this is about funds flow statement. Then let us see what about the cash flow statement. The same funds flow statement can be converted into cash flow statement with minimum or simple some addition and alterations. The very first thing of converting the funds from operation funds flow statement from cash flow from funds flow statement to cash flow statement is we need to convert the funds from operation to the cash from operation, because in cash flow statement we need to consider the cash from operation only, not the funds from operation. So how to convert the funds from operation to the cash from operation? There is a simple equation for that. The funds from operation has to be added with decrease in current assets, has to be added with increase in current liabilities, has to be deducted by increase in current assets, has to be deducted by decrease in current liabilities, and the resultant would be the cash from operation. So cash from operation is equal to funds from operation plus decrease in current assets plus increase in current liability minus increase in current assets and decrease in current liability. So cash from operation would be an inflow of cash, and cash lost in operation would be an outflow of cash. This is the first item to be remembered while converting the funds flow statement to the cash flow statement. Then the second item to be remembered is the cash and bank balance are to be treated separately, although it is a current asset, but they are to be dealt with separately while preparing the cash flow statement, so it has not to be merged with other current assets when the following opposite equation is taken into consideration. The last stage or the last step to be remembered in case of preparation of cash flow statement is the net increase or decrease in working capital has no role to play in preparation of the cash flow statement. While preparing the cash flow statement, the opening cash or bank balance has to be taken into consideration, or inflows are to be added to that. All outflows of cash are to be deducted from that, and the net resultant would be the closing cash and bank balance. And that closing cash and bank balance must tally with the figures given in the balance sheet. Opening figure must tally with the figure given in the balance sheet. The closing balance figure must also tally with the figures given in the balance sheet. So this is all about preparation of cash flow statement. A small part is being left, which we will discuss in the next class because of the paucity of time. Thank you. Thank you all.